Welcome, everyone. We're going to be talking a bit about finance today. A lot of you I've been talking to on the phone, and you've been mentioning, okay, how do we put this together? How do we get the money? How do we find the equity and the debt and everything else for our commercial properties? Now, Tim's here with me, and we've got
Hello.
Andrew Kubank as well on the line. We're going to be talking to you today a bit about that. We're just going to get into it and run through this. So you've seen this before. You've seen the funding stack. Tim and I have talked about it before. You've got your first mortgage down the bottom, your second mortgage. You've got your equity part of the deal. You're looking at your purchase costs and your project costs on top of the deal. What we want to do is we want to simplify that a little bit, and we're going to talk about cash and debt. Easy.
Make it nice and easy. So the top three are in cash, and obviously first and second mortgages are in debt.
Yep.
And they're sort of the things we're going to run through. So with the funding stack, when we're looking at cash, the places that we're looking to find that is either your own money. We're going to talk a bit about vendor finance. And then the last one is if you don't have your own money, then you're looking for someone else's money. So that's when we're looking at joint venture partners and breaking them down into retail investors, wholesale and professional investors. And debt, we're going to look at traditional lenders, which is what we've got Andrew to come in and talk to us about, and the other one, private lenders as well, which I'll talk briefly on. So,
just on this, when we're looking at how we're putting this together, we want to look at, okay, what's the total money that we need to put a deal together? And let's look at the cheapest money you can get first. Usually that's the traditional lenders. Then we work our way up. We're going to look at private lenders. So this is the way we're going to talk about it today. Traditional private lenders. Then we're going to look at, okay, if we can't get all the money from that source and we haven't got a lot of our own money in it, where else can we get the money from? And that might be vendor finance. It might be joint venture partners. But as you get up in these levels, you'll be releasing more and more of the profit from the deal and losing more and more of that. So just be aware of that. We'll cover these off in that order.
Good point.
Let's go.
All right, so let's look at debt. So first up, we've got traditional lenders. So just to give a very brief overview, I guess, when we look at debt, we're looking at first and second mortgages. So traditional lenders like the banks will not do second mortgages. They'll only do first mortgages, and typically it's up to around a 75% LVR. Interest rates in that 4 to sort of 9, and probably 4 is probably a little light on at the moment, but and then terms anything from 1 to 30 years, and time frames sort of 6 to 8 weeks. For the bank. So from a high level point of view, that's where it's at. But what I really want to do is get an expert in, and it's who Wayne and I use when we're getting our commercial finance, who a lot of you know is Andrew Kubank. So thank you for joining us on the call. So I'll let you sort of take it from here and tell us everything about getting finance for commercial properties.
Sure. Thank you very much, guys. And hi, everyone. So I'm sure a lot of you before have heard me talk about, commercial finance, and it is a little bit different, but not substantially different. A lot of people get scared by commercial finance in comparison to when you've just had experience with resi. So look, today we'll talk a little bit about, well, from the residential finance that you have experienced, how is commercial different? How does it work? What does the process look like? What loan to valuation ratios can you expect? What does cost look like? Timeframes. And then I'll speak a little bit at the end about just approach, in the sense that I like with commercial finance, we take a very professional approach as well. So kicking that off, look, the sources, at least, of commercial finance are a lot of people that you would know of, so all of the major banks are involved. What we find with the major banks is that they always have the highest requirements, but generally they can often offer the lowest cost. Following on from that, we've got the minors or the second tier banks. Again, they're probably names that you've heard of before: St. George, Bank of Queensland, and others. And then, of course, we've got the experts on private money here as well. So I'll let them talk about that rather than me talking about it. But at least from a mechanism perspective, they source funds from all over the place and pull it together. The beautiful thing about private money is that they will have the lowest requirements usually, but of course that comes at a cost.
Yeah, cool.
So I guess moving on to loan to valuation ratios. So again, often you've experienced in residential finance that 80% lend is the norm, and of course, using lenders' mortgage insurance, we've got the ability to push past 80%, potentially all the way up to 95%, depending on the situation. You're not going to experience that when it comes to commercial finance. So commercial loan to valuation ratios vary quite substantially, from as little as 20% all the way out to 80%, and in some very, very rare cases, 100%. But usually it's about the type of property that you're buying and the location that you're buying. And the thing is, there's no standard loan to valuation ratio as such. It very much does depend on what it is and where it is. So when we're talking about leasehold property, so leasehold property is where you don't obviously own the underlying dirt. You only have a right to occupy the dirt by virtue of a lease. So a thing like a pub or a caravan park, or essentially anything where you don't have the underlying dirt. Motels are another situation. Leaseholds are usually, you'll get a loan to valuation ratio somewhere from 20 to 50%. Owner occupied commercial property is probably the other end of the scale. So that's the leasehold is the lowest end, owner occupied commercial is the higher end. Generally with owner occupied commercial, we can be looking at really good LVR such as 80. And as I say, in some rare cases for things like medico and that kind of thing, doctors and dentists, banks are often prepared to even push out to the full 100%. For us, most of us, we're looking at tenanted investments. Usually tenanted investments will fall in the sort of 65 at the low end and 75% in the higher end. Now, generally, the more regional we go, the less players we have. So what that means is that the big banks are effectively prepared to lend pretty much anywhere. It doesn't matter where it is, they will be interested in lending. But what they will do is compromise the loan to valuation ratio. So, often people will ask me, well, can I get a really high LVR, but can I get that in Whoop Whoop? Well, the reality is probably not. The further out you go to Whoop Whoop in the smaller town, the more risky the bank views it as a result of that, the lower loan to valuation ratio that they like to apply. At the other end of the scale, of course, if we're talking metro and good tenant investments, they're often, they view that as less risk, and as a result of that, they're prepared to lend more against the property than they otherwise would. So usually better property, better tenant equals better loan to valuation ratio. But the key to take away from this is you can't automatically assume a loan to valuation ratio. It is quite property specific and situation specific as well. So you've got to work hard at that in the early days to understand what position you're going to be in. Now, a question I get all of the time is, if I buy a property and I do something to change it while we're potentially in a long settlement period, and I get a higher valuation as a result of that, or I add value to the property, can I apply the valuation amount rather than the purchase price? So the thing to understand about that is, yes, but it is relatively unique, and it's not a fait accompli. It's not a guaranteed outcome. So what the bank's standby rules here are that they will apply the lower of purchase price or valuation. So whatever is less, that's the most conservative. That's what they want to take. That's what they want to apply their loan to valuation ratio of. In some cases where we can demonstrate that we have, substantially changed the property or substantially added value to the property, and obviously we can get an external valuer to support that high valuation, the banks actually can look to apply the valuation as opposed to purchase price, but it's not their norm. So what that comes with is that they don't really want to also apply a stretch or a higher LVR. So what I say in these situations is that their base LVR, which is usually a 60 or a 65% lend, they'll only want to apply their base LVR against the higher valuation, as opposed to potentially stretching the LVR if they were only applying purchase price. So it's certainly something that can be looked at, and it's certainly something that that has been achieved in the past, and we've achieved it multiple times. But it's more a case of I would never want to guarantee that outcome, because we are asking the bank to depart from what they ordinarily would do.
Yeah, because that's.
But it's a question I get all the time.
The Shepparton deal that you got us to finance.
Absolutely.
From ANZ, and I think one of the big takeaways that I got going through that process with you is that the value add has to be sort of cemented in. So that the reason they were happy to take the uplifted value was because I was only going to settle 30 days after the actual titles have been issued. So as soon as the titles are issued, that added that value after I'd done the strata title. So that was a bit different. The question I had
in that situation, sorry, Tim, go.
Like, let's say you're buying a property for, say, $3 million, and let's say the uplift in value, let's say for some reason it's $10 million. Is there any rules, or have you had any thing come up where the banks don't like it if you're not putting any money in? Like, even though it's 60 or 65%, is there a limit where they want you to put some hurt money in, or have you come across that at all?
It's not a case of that they have a particular standby. What we're experiencing there, or what we see there, is that, and this is something about with commercial finance, that we've always got a credit manager. And look, a lot of people that have heard me speak about it before would hear that I refer to them as the cardigan wearing cat lover, which just means it's that conservative person that hides, that hides in the ivory towers and makes a decision. What we find is that it's actually more of an attitude than a hard policy. So the banks don't have a hard policy that says, well, you need to contribute X dollars or X percent into a property. It's more of a view that they don't want to feel like they're taking 100% of the risk. Now, so there's no hard and fast rule there. It's really an attitude. So what I would say is that, again, this is where we get a little bit back to that case by case, in that they like to see some hurt money in there from coming in from you, or some cash. They don't necessarily want to be the only one funding the deal. But that said, it's not hard and fast. I mean, a strong enough property and a strong enough location where they get, they're very, very comfortable with the deal. And let's say that a property did improve that substantially in value, they can see, as long as there's very little risk for them in taking on that property, they wouldn't necessarily absolutely say you have to put in hurt money. Right. So it's not, as I say, not a hard and fast rule. It's just about, it would have to be a very strong deal, all told, for them to go, yeah, we're actually comfortable with the idea of you not putting money in here.
Gotcha. Okay. And what about cash out? Or is that going to be pushed?
Cash out is a whole different, cash out is a whole different situation. So now the interesting thing about cash out. Sorry, what was that?
Cool. Let's talk about terms.
So, terms. So look, loan terms these days with commercial are actually starting to approach what we see in residential anyway. So there's actually less disparity here than there used to be. Back in the day, when I started in commercial finance 20 years ago, it was like, no, 15 years is the maximum term, full stop. And to be honest, permeated through largely the majors, it still sits a little bit where they don't like providing a term of longer than 15 years. But we are seeing some of the second tier lenders who they can compete on this kind of front. So as a result of that, they actually offer these days 25 and 30-year terms, which is great. Mm-hmm. The only thing to think about this is that usually when they actually assess whether they will provide the finance or not, they're usually assessing that against a shorter term. So what we see in commercial, or again, what's experienced, is that because they consider it to be, I guess, more risky lending. Weirdly, I actually consider it to be safer investment, but they assess it as more risky lending. They want their money back faster. So usually they'll actually assess the loan over a 15-year term, which as a result, or the implication for us there, is that it actually increases how much money we need to be able to generate or prove to the bank to be able to repay the debt over a shorter period of time. So we do have to acknowledge that, assessment for commercial facilities does come with those higher requirements, and they're a little bit, so the hurdles are a little bit higher to jump over.
Now, Andrew, when you talk about servicing, what are you talking about as in proving income, or what do we need to prove an income?
Well, I mean, effectively, it's no different to what everyone's experienced in residential, in the sense of they look at, obviously, the income from the property itself by virtue of a lease agreement, or whether it's an existing lease agreement or it's a new one that's starting, doesn't really matter. They're happy with either. And then obviously they take into account all of your external income and all of your external liabilities as well. And what happens, again, similar, but slightly different to resi, is that all of that gets thrown into one big bucket. So all of your different income sources, be it PAYG income or self-employed, plus lease income, plus any other rental that you've got, all of that goes into one big bucket. And then out of that bucket, they obviously take all of your existing commitments. So things like they have an allowance for living expenses, tax, all of your existing debt, and being able to service that on a month in, month out basis. And then essentially whatever's left in that bucket, if that is enough to be able to service the proposed facility, or pay for the proposed facility on a month in, month out basis, then they'll tick that box and you'll get the money. Great. So that's kind of that's the process that they go through. Look, coming back to terms, interest only is completely normal in commercial lending. 5 years is usually okay as a startup. What we do see is that banks can often look to reduce their term in line with WALE. WALE is weighted average lease expiry. Again, I'm sure you've had exposure to that through your education.
Yeah.
But all it really says is that if you've got one big tenant with lots of money or bringing in lots of money and you know, the whole deal is hugely reliant on, and they're on a 12-month term, obviously the bank, or a 12-month lease, you know, obviously the bank's going to be a little bit concerned about what happens if that, you know, tenant decides to move on. As a result of that, they sometimes like to bring their term shorter to line up with that. So it just gives them an opportunity. The extension of the term or the expiry of the term just really gives the bank a bit of a break point to come in, have a look at it, make sure that everything's okay, everything looks fine. You know, okay, well, if everything looks fine, beautiful, we'll extend the term and we'll all move on. So that's what I've said there at the end, that, you know, extending the term is really no issue. I've never had any challenges with it. What they often can ask for is a revaluation to make sure the property is you know, still valued at least at what it was or better. And there hasn't been any erosion in value there. But if you're being a good boy, making your payments, the reality is the bank doesn't want their money back anyway. You know, so they'll usually just extend the term and everybody will move on.
Great.
So cost. Well, obviously, you know, commercial finance is more expensive than residential, and there are some other costs that you consider that you may not have been exposed to before. Interest rates, you know, when we're talking about majors, you know, I've got a good range of 6 to 8%. That'll cover most situations. What I have actually found in recent years is that the differential, there was always about a 1% or a 1.25% differential between residential finance and commercial finance. Now, obviously, recently, you know, we've all seen the residential investment interest rate market fracture a little bit. And now, you know, there's quite different interest rates for owner-occupied residential and investment residential, and particularly investment interest only. So what's actually happened is in a lot of cases, we've seen, you know, that residential rate has sort of pushed out, and we've seen the commercial rates become more competitive, particularly from the majors and the minors. And as a result of that, that differential is, you know, is less than I have ever seen it in history. So I must admit that my view at the moment is that commercial money is really cheap. It's certainly the cheapest I've ever experienced, which makes it a really good time, obviously, to be borrowing commercial money when it's the cheapest I've ever seen. But as a guide, you know, I would say the certainly 6 to 8% would cover more, and in some situations when bank run specials and everything, you know, you can get under that. And as a result, and obviously, as I said before, you know, private money, which you guys will talk about, is more expensive and can range all the way up to 24%, depending on what's going on. Establishment fees are something that you will experience in commercial. Generally speaking, these days in residential, it's rare to pay an establishment fee and it's all encompassing. Establishment fee is quite normal in commercial. You would expect to pay anywhere between 0.5 and 0.75 of the loan amount for the majors, and then obviously the other end of the market, up to 3.3% of the borrowed amount for private money. Valuation fees are also something that you'll experience. So again, residential, generally a bank will pay for a valuation. In commercial, they never pay for a valuation, which means you will be exposed to that. Time and type of property matter here. So usually you should be able to get a cheaper, so let's say $1 million to a $3 million property in a metropolitan location. You'll probably get that valued anywhere between, from a cost perspective, anywhere between about $1,500 and probably $3,000. We start talking rural, it's a bit of a different situation. Commercial valuers are specialists. As a result of that, we're forcing someone to travel somewhere. The travel cost is astronomical. I don't know what they drive, fly, or whatever to get there, but you can find that, you know, to value a regional property can be very expensive, largely because of that travel cost. Type of property can also matter there as well. So anything that's got a business attached to it, and we need a going concern valuation. So again, I come back to a thing like a pub or a motel or anything like that. They are also a different type of valuation, much more expensive. You would expect, you know, that a vow in that kind of space will cost you $5,000 to $7,000. Another consideration is time frame in commercial. So, you know, I say it a lot and experience it constantly that the wheels turn slowly in commercial. It isn't really that hard. It shouldn't take a long time for them to do what they do, but it's just something that you experience with the industry, and particularly with majors and minors. So what I would say is that from a process perspective, expect from the point where we're giving a bank an application to the point where they're actually coming back and giving us an approval would be a month. It's a much more detailed, a much slower application process. Those cardigan wearing cat lovers on the other side, they love to get into the detail. You can expect that they will ask tons and tons and tons of questions that no one really cares about. But whether it's them, justifying their existence or what it is, I can't really say. All I can tell you is that they're pretty hard to keep happy, and they will always find something to come ask and ask a lot of questions about. I know you guys are going to talk about, private money, but one of the key advantages of private money is pace. Just the sheer ability to be able to turn things around very quickly is a massive advantage of private money and can make things, so it's a huge advantage there. Now, I do like to talk about lease stocks. Lease stocks are a very specialist bit of policy that sits inside of actually not so much the majors, but more the second tier banks here. Not every bank participates in this, so it is a very it's a smaller market. I think at the moment there's 5 or 6 different lenders that have a lease stock type of product. But what it is a special bit of policy, and that policy says under a lease stock application, we actually don't care about what's going on in the rest of your world. All we really care about is the income that's coming from the property, and all we really care about is the property. So what they do is their application process essentially isolates the property by itself, and if the rental from that property is enough to be able to service the proposed facilities, that is quite literally as far as they go when it comes to what they look at. So this is fantastic for situations where a cash-funded retiree who doesn't have other income to be able to demonstrate to a traditional bank, it's a way that they can potentially lend to, get into a commercial property. Potentially someone that's just got lots of equity and not necessarily cash, and it's a really good performing property. And also, particularly with all of the changes that we've seen over the last few years with how tight residential lending's become, for people that can't demonstrate servicing from a traditional perspective, but as I say, have the cash or equity to invest, this is a bit of policy that can be really fantastic. So we don't need to show them everything else that's going on. We just got to show the property. It is a lower LVR, so some considerations are it is a lower overall LVR. Effectively, in this space, it's one of the things that the more you want to borrow from an LVR perspective, the more expensive the money gets. So I like to do this lending at 60 and 65% because that's where the cheaper money is. But in some cases, particularly recently, we've actually seen where lenders are prepared to see it sort of push towards the 75s, which is fantastic. As I say, it's a loaded interest rate. This is a facility where they're effectively bearing the higher risk by not knowing everything that's what's going on. So as a result of that, they want a better return. So we can expect to, pay a premium on that. And there are obviously restrictions around the lease itself as well. So they want to know that, it's a good lease, that it's in place. Lease needs to have a minimum of 12 months to run. So this is not a situation where you could look, for argument's sake, at a vacant property with no lease, unless you had negotiated as part of buying it that you had the time to be able to fix that problem, and then as a result of that we could go and do a lease stock, which I have done that in a few situations as well, and it works really well. The last point about lease stocks is that because of the lenders that participate in this market, we do have to be careful about going too regional. So again, we get back to the minors, basically the more regional you go, the smaller, the bigger banks continue to play, the smaller the bank, they start to bow out. So this is not necessarily a type of facility that you can take to, the smallest towns in Australia and be able to take this approach. It does, isolate more heavily around the bigger metropolitan areas, but fantastic product.
Great.
Now this is just some other considerations. So things like there is interest coverage ratios that the banks have an expectation. So interest cover just essentially means from net cash flow, do we have the ability to cover the interest bill to a certain number of times? And so what they're essentially looking for here is that net cash flow is at least 2 times what the interest bill look like. That gives them some comfort that from a cash flow perspective, you're not going to have any trouble actually paying the interest bill. Maintaining LVR requirements. So this is essentially over the longer term, and it's additional conditions that are fairly standard in a commercial lend. It essentially means that if they have an erosion of value in the property for any reason, it's in the fine print, that they can obviously go and value, and they can actually look to call in or force repayment of a facility down so that they can maintain their overall LVR. So in other words, if they provide it at 70, a 70% loan to valuation ratio, and for some reason the value of the property erodes, they can actually come back as part of a review, or theoretically at any time, although it'd be rare, but theoretically at any time they can actually come back to you and say, well, we want to revalue the property is now valued lower, we provided a 70% loan to valuation ratio, and as a result of that, we'd actually look to, we want you to make a reduction to the facility to get back to the 70%.
Like a margin.
Again, thankfully, sorry?
Like a margin call, like in the stock market.
Yeah, it is like a margin call, absolutely. Yeah. Again, thankfully, I don't see a lot of it, which is great. Usually, banks sort of default back into a tick the box and move on if everything's fine. That said, they absolutely can, and it's important to understand that they can do that. Rolling over, so again, we get back to a bit of a term issue. So I have a default preference that the longer the term, the better, in the sense of if it all fits and we haven't, got requirements around the WALE, the weighted average lease expiry, and we can get ourselves a 25 or 30-year term in commercial, I'm a big fan of that. Because generally speaking, it won't give the banks, as long as you behave yourself, it won't give the banks a reason to, to look too closely at it. So that said, though, I am actually quite comfortable if the situation calls for it that we are on a shorter term, expecting, though, that they can call for things like valuations and other things. So again, I prefer that longer term so they don't look at it. But, if the situation calls for a shorter term, we can live with that, and we'll just make sure that we behave ourselves and everything should be fine. Bank control and directors' guarantees. That is essentially in a situation, actually, would you guys like to talk about this?
So when you're looking at control, the bank's going to want control over the asset, obviously, the property. It also wants to be able to get control of the holding entity. So that might be, if you set up a trust to contain that entity, it will want to take control of that if ever, you start defaulting on loans or things like that. It can also, a lot of banks will also start looking further up the chain to look at if you've got an entity that, like a trust within a trust, it will start looking further up the chain to see what else it can grab hold of. When we do loans, we tend to try and limit that. We don't want the banks controlling AC Capital, which is our controlling entity. We want the banks only to look at AC Shepparton, which might be the entity that holds the property, our holding entity. So, it's about limiting how much the bank can take if ever anything goes wrong. You want to limit that risk exposure.
Yeah. And for me to take that a step higher, my experience with all commercial lending and commercial lending generally is that the banks will try and get their fingers into everything that they can, and we do have to be quite conscious of that as we go through the process, and limit how far they get their fingers. So, and sometimes they can be a little bit negotiable on these fronts, in the sense of one of the things that's usually not negotiable is that they will want directors' guarantees. So they want the director, and that's the individual to absolutely be involved in that, and have them on the hook for it. But as you say, quite often when it comes to a middleman entity or even an end controlling entity, they don't necessarily actually have to have guarantees from that entity as well. As long as, so my argument with them will always be, well, if I give you the directors, you actually limit how far you're going to stick your fingers into everything, because the reality is if you've got the individuals, that's probably the most important thing to them, but you've got to watch their defaults. They will try and register against companies, you name it. And unfortunately, it's one of those things that's all in the fine print. And when you see the security schedules come out for commercial loans, it can read like gobbledygook, so you do have to work through the detail of that and try and make sure they're not getting their naughty little fingers into everything. From a interest rate perspective, so this is particularly when we talk about things like bill funding, The way that an interest rate is essentially created, to get to your end rate is again a little bit different. It's not just a straight rate like you often get from residential. How it's actually built up is that there are base rates, and base rates are essentially like we're talking. You may have heard of BBSW, BBSY. They are bank bill rates that get set effectively at a market level across all of the banks. So there's quite an open market to that and where that gets set. And then from that base rate, we'd love to be borrowing at that, don't worry. But from that base rate, they then build up margins. So the bank themselves will put a margin on top of that, which again is relatively variable but fairly competitive across all of the banks. And then they put a customer margin on top of that. And the customer margin is essentially a composition of how strong you are, how strong the property is, where they see the level of risk, because you do get, call it risk rated by the bank, and you get given a special little code, which won't mean anything to you, but it means a lot to the bank. And as a result of that, they're basically saying, well, how risky do we see you, the client, plus, the property in the deal? And then obviously they price accordingly on risk. So the structure of that is a little bit different. As I say, it's built on a base, and then obviously they build up lots of margin to get to a final rate.
And that customer margin can be a negative, can it? We've seen some of ours can be like a negative as a saving on the margins.
Yes, that's right. And usually when you see that, it's a case of the business margin that particular financial institution uses is large, so they actually do it as a bit of a deduction. And where people would see that, or something you could compare that to, is in the residential space, where the banks themselves have usually a standard variable rate, for argument's sake. And then because you're a package, or you're on a package, or you've borrowed a lot of money or something like that, you actually get a reduction on that standard variable rate. It works very similar to that.
Okay. Cool.
So making your approach for finance, and this is something that, is pretty close to my heart. The thing, again, and I'll come back to the cardigan wearing cat lovers, the thing about, many decades, or a couple of decades now of experience with commercial credit managers is that they are, generally speaking, conservative people. They can be quick to judge. They all have their little bugbears, the things they like, things they don't, and everything else. Whereas, in a residential environment, it's a factory. It's very much a tick box exercise. If you tick the boxes, then you get the money. In commercial, we've got, to be honest, probably a more intelligent, better paid, and someone with more time on their hands. So what that translates to for me is that, again, without being cruel, they've all got a job to do, but they're quite judgy. And because they're judgy, as we only get the opportunity to make a first impression once, we want to make sure we're making a good one. So things like, they expect that financial information is up to date and accurate. They hate overdrawing, they hate late payment, because for them, it demonstrates that you can't take financial responsibility, and which I don't necessarily agree with personally, because it can be something as silly as, you didn't even use a credit card, but you're supposed to make a standard $25 a month payment on it. You don't do that. They see that as hugely financially irresponsible, and for the life of them can't imagine why you would have more important things going on than not making a $25 payment. But what it means is, unfortunately, we can't influence that, and that's what they're like. So it's a case of, let's understand that, and let's make sure that we're putting something in front of them that they're not going to get judgy about, that they're going to be happy about, and as a result of that, try and look to support the transaction. A situation where, a lot of people ask me, well, I haven't been hugely experienced in this. Look, if we need experience, and it's something that this tends a little bit more towards things like commercial development or land development, those kinds of stretches of commercial finance. But if you don't have experience, absolutely hire it. In most cases, when it comes to, long-term commercial property investment, the banks don't actually have an expectation around experience anyway. Even if I'm plugging myself here, the reality is the advantages of using a broker is that we are, if nothing else, we are a stopgap between you and the cardigan wearing cat lover. So it's an expectation of any, good commercial finance broker that they're actually making sure that rather than you filtering all of your terrible information through a bank direct, you're actually filtering it through a stopgap before it gets to the bank. And that gives you and me, the opportunity to tidy all of that up, make sure that we are going to make that really good first impression, and make sure more than anything else that we're not going to raise any red flags that would result that we don't get a successful outcome, and we get to be able to do that early. Now, a side benefit of that is naturally we get to see where the whole market is at any given point in time from a price perspective and from a cost perspective. And, when it comes to policy, the reality is all banks don't play in every space. So generally, I always feel that there's usually a good home for a particular deal. And that home might only be one or two banks across the entire market because they're just better at it, and won't necessarily charge you as much as other banks will. So yes, we've got to be organised, got to be professional, and I'm very strong on trying to make the right impression the first time around.
Absolutely. So, yeah, beautiful. Well, thank you very much for that, Andrew.
Yes.
Yeah, absolutely. I agree with what you're saying. Definitely use a broker. I can't imagine why someone would try and do it themselves. I mean, even
just have a lot of time on their hands.
but it's also doesn't.
Yeah, well, that's exactly right.
That is paying the broker. It's not like it's going to cost anymore.
Exactly.
And I know when we do lending as well, like we have the same establishment fee or approval fee, no matter if they come through a broker or not. So why not get some parallel work for you?
Absolutely.
Yeah, absolute no-brainer. But anyway, thank you very much for your time, Andrew.
My pleasure.
We'll chat to you soon.
Look forward to it. Thank you, guys.
Thanks, Andrew.
See ya. Okay, so let's look at the next, the private lenders. So this is where we're looking for private lenders in professionals who lend money who aren't a bank. So as a lot of you know, I've got Private Mortgages Australia, and we specialise in this area. So you'll see the big difference between a private lender and a traditional lender is that you can get second mortgage funding with a private lender, which you'll never get from a bank. But probably the big ones is flexibility. So as you heard Andrew say many times, that there's that cardigan wearing cat lover, that they're very, very hard to get past sometimes, and they're very, very picky, and they want a lot of information. They're going to dot every single I and they're going to cross every single T. Whereas there's a lot more flexibility with a private loan. They're more looking just at the asset. It's almost more like that lease stock sort of loan, as opposed to looking at the individual and serviceability and credit and all that sort of thing. So that's some of the bigger differences. In terms of LVR, you'll see we've got here up to 75% LVR for commercial lending, and it's not really that much higher than the banks. So you wouldn't so much use a private lender so you can suddenly borrow heaps and heaps more money, but you might have some flexibility where they might give you 75%, but they'll use the higher of valuation or purchase price, whereas a bank will do the opposite. So you can use things like that to get higher LVRs, but very hard to get anything past a 75% LVR with any lender really in the marketplace. Interest rates, a little bit more expensive, designed to be more used on a short-term basis. So you can see there interest rates from sort of 9 to 36% per annum, but terms you're only looking for sort of that 2 to 36 months. So most of the time with private lending, I would say our average loan is around 6 months. It's not designed to be a 25, 30-year loan, which is why the interest rates are a little bit more expensive. And you'll see the time frame there as well. You can get loans done within a couple of weeks. It's not, you wait a month just to get an answer, let alone documentation and settlement and all the rest of it. So that's the sort of the big differences there. And a good broker like Andrew will, he'll obviously do what is best for you. He'll try and get the traditional loan first and get the cheapest money, and then if they say no, he'll slowly move up the list. He'll go to some of the smaller banks and then get into private lenders. He's not just going to go straight to a private lender because it's simpler, but it's just there as a bit of a stopgap, I guess. Usually it's so that you can get something done, and then you then go and refinance with a more traditional lender down the track. All right, so let's look at when we're looking at lending, and particularly private lending, I got taught about the 3 Ps, and so this is what private lenders will look at when they're assessing a deal. And the first one is people. So they'll actually look, who are the people behind this project? And the biggest thing to keep in mind is that they actually do it in this order. So people, then the project, then the profit. Whereas most people focus on, how much profit is the deal making? Whereas it's more important who's behind it. And this is even more pertinent when you're talking about development, because you need someone that's got a lot of experience. But even this, they're looking at the person, what sort of experience they do, how long have they been investing, what other properties have they got, and just looking at who they are and the experience that they have. Next, they're looking at the actual project. Is it a good area? Is it a bad area? What tenants do you have in there? How many tenants? Is it a good market? And then the final thing is the profit. So is there enough profit in this transaction? And same again, this is more looking at from a development point of view, but it still applies to commercial as well. Is how much profit or cash flow is in this deal, or value uplift is in it that they can actually access. So that's a couple of things there that just supposed to be aware of what they're going to be looking at. The other one I want to cover, especially when we're looking at private lenders, is a few things that other private lenders do that you really need to be careful of if you're not using a respected private lender like Private Mortgages Australia, if I don't say so myself. And this is where you'll see other private lenders who have from rates. So we have interest rates from 1% per month, but you have no idea what the up to is. So the old example I had is a firm. We have interest rates from 1%, but a lot of the time their actual offer would actually come back at 6% per month. Okay, so the 1% was just to sort of get you in the door, and then when they knew you needed the money at the last minute, they'd say, it's from 1%. Well, here's 6.
That's a bait and switch, isn't it?
That is, yeah. The other big one we see is big upfront fees before the final offer. So we saw one the other day. It was an $18,000 payment that they needed to make. Now, fair enough. I think a portion of that was to cover the valuation. But even then, before the person even saw the final offer, they had to pay this $18,000. And if the deal didn't proceed for whatever reason, then they lost that money. So just something else to keep in mind.
When you say final offer, what are you talking about? What the rates are and things like that?
Yeah, in terms of the actual rate and the mortgage documentation and the final formal letter of offer.
And what they're taking control over, so you don't even know any of that before you pay the $18,000. Wow.
No. I mean, so a lot of them do have details, and they'll have an indicative rate and those sort of things. But for me, you shouldn't really be paying a lot before you know exactly what the interest rate, the costs are. Everything's all set to go. So compare that, like with Private Mortgages Australia, we charge anything from $550 to $770 up front, based on the complexity of the transaction. And for me, that's about right. That covers a bit of our costs in terms of doing all the checks, and that'll even cover the desktop valuations that we do. It's the only time you'd spend more than that is if we have to get a formal valuation done, and that will always be done at cost. The other thing we look at and we see in the marketplace is these 24-hour loans. To get a 24-hour loan and to get a first mortgage is just it's very, very hard to do, because you're talking about someone making an application. They do all the due diligence, loan documentation, signing and drawing down and giving you the money in 24 hours. I mean, that's just ludicrous. I mean, I think, and at PMA, we don't do 24-hour loans. I think the most we've ever done is 3 days. We've done quite a bit of stuff in that 3 to 4 day sort of space, but most of the time it's in that 1 to 2 weeks. Now, even these providers who say they do 24-hour loans, the reality is they're just using this as a piece of marketing. I desperately need the money. Great, 24 hours. So you get in, they'll sign you up. They might sign you up in a big, pay some big costs, and then 24 hours later, we just need a bit more time, or we need another 24 hours. We need this document from you, this document, and they just keep documenting you and to document you to death, sort of thing. And I would always ask, well, how many loans have you done in 24 hours? Because the answer is probably not many. The other one is very expensive valuations. So first thing, they're making a profit on the valuation, which I think is ridiculous. But the other one is look at the purpose of the valuation. So I saw one the other day and it said, we need to get a valuation, and it'll be done on the basis of a forced sale. So what I like to see is the purpose of the valuation is either for mortgagee purposes or it's for market value purposes. So we want something that's going to be a realistic value, not forced sale where we're basically telling the valuer, give us the lowest possible value that, if we had to rush to sell it, And so usually that'll come in, 10, 20% under value. So same again, they might be saying, hey, we'll do a 70% LVR, but by the time they get their forced sale valuation that comes in at 90 or 80 cents in the dollar, then it means they're going to lend you a lot less, and you're not really going to get a 70% LVR. The last one to keep in mind is cancellation fees. So a lot of the time, even in their indicative letters of offer, they'll have a cancellation fee. So if the loan doesn't proceed for whatever reason, so if they pull out, being the lender pulls out, or you as the borrower pull out, there's a cancellation fee. And this might be a couple of % of the loan amount. And what they'll basically do is they'll have a charging clause in there that it allows them to put a caveat on your property, and they will basically hold that property to ransom until they get paid their cancellation fee from the loan. So just be very careful of any charging clauses that are in the offer. Cool. So let's. The other thing we want to look at is private lenders and vendor finance. So I see vendor finance as just another way of getting private money. Instead of using an institution, you're using the owner of the property.
Money from the owner. Yeah.
Money from the owner. I mean, look, sometimes you can only get the deal done. You can only buy the property if the owner provides vendor finance. So they can sometimes be quite motivated to do it. I've got here that they will look at first and second mortgages, and they will do up to 100%. Very, very hard. The closer you get to 100% LVR, the harder it is to get an owner to actually agree to it, because they're like anyone. They're going to look at the risk and say, well, if you're going to go and get 60% from the bank, and I'm going to give you a second mortgage for 40%, well, then I'm sort of, you're not putting any hurt money in, and it's 100% geared. So as much as you can do it, most of the time I've found that you're probably more tapping out at your 80, even 90%, because they want to see that you've got some hurt money in there.
Where's vendor finance and commercial property? Be aware, unlike residential, these people who own commercial properties are usually more financially savvy. They're doing it because they want an income, and they're doing it for financial reasons. So you've got to present your case as a financial case to them. Same with residential as commercial. Know what they want, what their aims is, why are they selling the property. If you know that, you can structure a financial case that will make sense to them.
And it could be like, you can, this sort of, this is all about the funding stack. So you might get a first mortgage of 65, you might get the vendor finance for an extra 15% that'll take you up to 80, and that's when you then get your joint venture partners or equity partners to come in and top up the rest. So you can do all different types of these. You've got here the interest rates, anything from 0 to 25%. The reason I've got 0 in there is that it can be a really good negotiation point. So Wayne and myself are looking at a property up in Brisbane at the moment, and the owner actually came up with the idea of doing vendor finance. And so one of the things that you can do to sort of, you can say, hey, look, I'll give you the price you want. I'll give you the $5 million. However, to buy back some of the profit, you might say, I'll give you the $5 million you want, but I want you to vendor finance the deposit to me, and the interest is included in the loan, or there is no interest. So that way, if you're not paying interest on that money, then obviously that's it's a form of a discount that you're getting on the purchase price in terms of terms.
Yeah, and that comes back to, if you want the price, and I want to dictate the terms. If you dictate, if you're okay on price, then we can negotiate on your terms, which might be pay you up front or pay you early or whatever.
The other point here I want to make, I've got a term anything from 1 month to 60 months. Now, could you get someone to give you vendor finance for 100 years? Yes. I've found that it's hard to get past 5 years. There just seems to be a bit of a ceiling for some people. Most people don't think more than 5 years ahead, so they don't usually like to have their money locked up for that period of time. So by all means, you can get more, just you might find there's a bit of a barrier there. All right, so that sort of covers the first bit, being debt, and that's always, we try and get usually as much money as we can in debt, because that's most people just charging an interest rate. They don't want to share the profit, and it's going to be a lot cheaper. So the next bit we really want to cover
cash
is the cash bit.
Let's get into the cash.
And that's where I suppose some people have a bit of difficulty finding the money, and I would say that finding the cash or the equity for a deal is usually a little bit harder than finding the debt. and that's because it's a little bit riskier as well. So
and that's because it's more formalised. The debt, there's a lot of financial institutions out there. It's a more formalised structure. With the cash, it's less formalised. Unlike the stock market where you can buy shares and put your equity in the shares, this one's a little less formalised in terms of how you get the equity for your property. Now, when we say cash, we're also referring to the project costs, which may be ongoing through a period of time if you're doing construction or any development, and it includes the purchase costs as well. So we're going to go into your own money line of credits. This is probably the first place to get your money from. So obviously, if you've got a lot of cash, and you can finance the project costs, you can finance the purchase costs, you can finance the equity, purchase price of the property. If you need to, and you've got equity in another property, you can use that equity as a line of credit. Now, a line of credits you're going to be a little careful of. You are basically creating almost a cross-collateralization situation where you're using money from one property to put into another. So when working with the banks on using a line of credit, you've got to be very, very careful about cross-collateralizations. Also be aware of your loan-to-value ratio requirements, your LVR requirements on your primary property that you're getting your loan-to-value, getting your line of credit from. So make sure you don't breach those covenants. If you've got an 80% loan or 80% debt facility on your primary place of residence and you're pulling that money out to put into a commercial property, make sure that it's only up to the 80%, don't breach it. That's probably the main parts of line of credit. Interest rates 0 to 6%. You do want to be paid some of your own money back, obviously, and that comes down to the structure of the deal. I mean, you are getting the profit out of it, so you might not expect any interest rate, and might just want a profit share or profit return. But you could structure it where you're actually putting in money and you're expecting an interest rate return to sort of finance yourself or to fund yourself a little bit better in terms of cash flow. So there are different ways of doing that. You talk to your accountant or your financial advisor about putting that together and how you put that together. Term, again, unlimited. Time frame, well, time frame is how fast can you put it together? How fast can you get your lawyers to put it together? Okay. Private money or private lenders, when it comes to vendor finance, you can negotiate clauses within your contract so that your vendor or your owner finances the project costs or the purchase costs. We've touched on these before in our webinars and our discussions previously at events where we talked about vendor financing and talked about special conditions and clauses in that. We'll give you those in a minute. You can talk to your vendor about leaving money in the deal or prior to settlement so that they can fund part of that. And it basically reduces the cost or the money that you need to put in for the deal. So those clauses are your project cost clause. The vendor is to reimburse the purchaser's costs to paint the building or anything you like, really, at an agreed amount of X, $35,000 in this case. The amount is to be allowed to the vendor at an adjustment at settlement. So this is basically sort of saying the vendor's going to give you, well, you fund it for $35,000, but you get the money back at settlement as a reduction in the purchase price. Your purchase cost clause, the vendor will reimburse the purchaser's stamp duty. It could be legals, it could be anything else. It's an agreed amount of $250,000. This amount will be allowed by the vendor as an adjustment at settlement. Again, a reduction in the price at settlement. Tim, so we got 3 types of investors.
Yeah, 3 types of investors that we're going to be getting money from, I guess. So the first bit we just went through is obviously, yeah, if you got your own money, that's great, or you can get some money from the owner. The next thing we're moving into is getting money from third parties. Now, there's basically 3 different types. So the first one is your retail investors. So this is your mum and dad investors. Pretty much anyone that's not a professional investor, I guess, is deemed to be a retail investor. The next level up we've got is a wholesale or sophisticated investor. Now, for someone to be in this category, they need to earn at least $250,000 a year and have done so for the last 2 years, or they actually invest $500,000 or more in one transaction. or they've got more than $2.5 million of assets. So normally what will happen for someone to qualify for that bracket, normally they'll have their accountant or financial advisor sign a certificate that says, yes, this person is a wholesale investor, they earn more than 250, or they've got more than 2.5 million of assets, or whatever. I mean, if they're investing 500, that's obviously quite self-explanatory. It's just the amount. The next level up, very, very small group, is professional investors. This is someone that controls more than $10 million worth of assets, or someone that holds an Australian financial services license. So that's very, very small group in there, and you can see that's someone who controls. So this is more your fund managers who are controlling assets that they don't need a lot of disclosure requirements, which is where this sort of comes from. So let's sort of drill down a little bit more into this, I guess.
So mum and dad. So this is your retail investors, is the family and friends. So when you're looking for money, first port of call is to put up the family and friends.
The bank of mum and dad.
Yes.
Often called.
My call.
Always the easiest place to find the money, I guess, because they already trust you. They already know that perhaps you know what you're doing.
Yes.
And there's none of that risk of, gee, I don't know who this person is or what they're doing. So that makes that they're a lot more likely to be able to give you the funding.
One of the things that we'll touch on in a minute is crafting your own story. When you're finding money, it's good to have your own story about how you're investing, your history and stuff like that, and crafting a bit of a story that people become interested in you and start to understand you and what you do. Now, with family and friends, they already know it. They've seen it. So it can be a lot easier. Can be definitely a lot easier to find money from these people because they know you, they've seen you make money, they've seen what you've been doing, and they go, oh, I want a piece of that as well.
So it could be as simple as, hey dad, or hey mate, I've got this deal, I need to raise $100,000, and that could be it. Okay, so in terms of what information that they might want, it's probably going to be quite easy. They're going to be very, very flexible. You might even have someone that will give you the money for no interest. Or it could be anything up to, say, 25% or a share of the profit, something like that. But I suppose it's a nice, easy port of call, and they usually don't require a lot of information to make a decision, is the big thing with this. The next one we get into is more your wholesale investors, so a lot more sophisticated. And one of the things with these as well is that you'll find as we go up the list, they usually have more and more money. Okay, so if you're looking at family and friends, it's very easy to find someone that's got 25 grand, 50 grand, even $100,000. But if you're looking to raise $3 million for a project, that's a lot of mum and dad investors you need to raise $3 million. So this is where moving to a wholesale investor who's a little bit more sophisticated, usually has a lot more money behind them, they're going to put a lot more in. And the flip side of that is they're a lot more professional. They're going to want a lot more information from you to make sure that this is a good deal. And they're usually a lot more conservative, and they're a lot more diligent. And usually that's the reason they have the money to start with, is because they're diligent investors. They don't just throw money into anything.
And it might be worthwhile touching on this point that if you are getting money from your mum and dad and your friends and family for to put into a deal, there are limits. So if you're getting money from retail investors, it's only 20 investors over a 12-month period, and no more than $2 million.
Which we'll cover towards the end in terms of what you need to be able to get. But there are some very important limits, and that's the main one from retail investors.
Wholesale investors don't count towards those limits.
Full on, yeah. So that's they don't count, which is always nice and handy. And normally, if we're looking, just get back to the returns, most of the wholesale investors, if they're putting in equity into a project, they're usually just going to want to share the profits. Because ultimately they're the ones, and we talk about equity or the cash bit. This is the people that are taking the risk on a transaction. Okay, so if there's ever going to be a loss on a deal or the property market corrects, the first people that are going to lose are these joint venture partners, whoever's putting the equity in. Whereas the banks and the secured lenders, they're the last person to lose money because of the LVRs that they've got. So this is why most sophisticated investors more look at a profit share as opposed to a fixed interest rate. Doesn't mean you can't get an interest rate from a wholesale investor, but that's just normally what they'll go to do.
And if there's more risk, obviously they want a higher return. So if you're looking at them putting a lot more money in, they're going to want more of the deal. Okay. Also, control. Control is an important thing for investors. Now, that might be they want to sit on there and make decisions with you while you're doing the project. But in a lot of cases, it might be if they trust you, they know you're experienced in what you're doing, they'll sort of say, you go with it. If you make problem or there are problems that come up in future, we then want to take over control of the project or the asset or whatever. So be aware of those and where those come in. So I mean, if you fail on a certain thing, if things go bad, then they might want to step in and take over.
And it depends on the project. I mean, that's more typical for development.
Yes.
Or if there's something, hey, you need to start development in 3 months or 6 months, or if they feel that something's gone wrong, they might sort of step in. The next level up is your professional investors. So these are your fund managers, and like Wayne and myself we've got active commercial, which its sole purpose there is to get into commercial property deals. And I suppose the more the basis when you're dealing with professional investors, it's not so much that they might put the money into your deal, but they might actually take the deal and fund it themselves. So that's more about passing the deal on to this like to active commercial, and you then get a share of the profits for the transaction, rather than them coming in as a silent partner. So they're more likely to take over control and actually do the deal, as opposed to just, hey, here's the money, best of luck. Yeah. Or if they are going to be in that more passive role, when we're looking at that sort of that private equity sort of space, then they're almost certainly going to have the clause that we were just talking about with the wholesale investors of they want control. They want to be able to come in and take over the site, or they're going to want the property to be owned in a separate, maybe a separate unit trust, and they might want to be the director of the trustee, or they might want to be the trustee of the trust as well. So a lot more control, but they're a lot more professional. But they're also going to want a lot more information compared to your mum and dad investors and that sort of thing. So just something to keep in mind.
This raises a point. I mean, this is a strategy for you to take on board. If you're finding deals, tie it up with an option or a long settlement contract, get some work done on the property, build up your own equity in the property. Now, you can do that quite cheaply. And then what you do is you can then sell that whole deal into a fund. So you can sort of approach all the funds with a pack and say, I've got this deal out of the equity. Here's a discounted buy-in price. But I want you to be able to give me equity in return. I want you to be able to give me some units in your syndicate, or units in your unit trust, if they're putting it into a unit trust structure, that allow me to buy my equity back into the property.
Yeah, so that way you're getting a share of the profits out of the transaction as well. So I suppose that's also, probably the order that I would sort of go in if I'm just starting out. Always, especially if you're not looking to raise a lot of money, you might find with like the wholesale investors and definitely the professional investors that they're going to have limits as to that they won't look at a deal if they're only going to put $100,000 in, because it's not worth the time. So like with active commercial, we won't look at a deal unless it's $3 million sort of price point. So whereas your mum and dads are happy to look at a $100,000 loan or $50,000 loan. So just something to keep in mind as to how much money you're looking to raise might dictate where you go as well.
Okay. And you're probably all asking yourselves, great, this is all great information. You've given me all the information about the market out there, but how do I actually do it?
Indeed. How do we getting investor
ready? How do you
get
investor ready? Okay. The first thing I mentioned before is your story. Now, you've got to take some time and craft your story. Think about your history, your investing experience, what has taken for you to get to where you are now. Build a story up, because people don't buy based on pure numbers. People don't buy based on logic. They like the story. They want to know where you've traveled, even in terms of the property itself. What is the property? What's the deal around the property? Why is it good? Spend a bit of time about that. Now, when you're out there talking to people, networking, talk about your story. Don't talk about the deals. Don't sort of say, give me money. Sort of say, I've done this and this and this, and I've made a bunch of money, and people have come along with me and they've made money as well. Now, what that does is in the back of people's minds, they go, a lot of people around you are making money. How do I get around you? The next step then is to put together your information memorandum. people are, although in commercial space, and as we were mentioning before with your different wholesale and professional levels, they want more and more documentation. They're going to want a lot of detail. So you've got to spend a bit of time on your information memorandum, and don't underestimate how much time it can take to put an information memorandum together.
Yes.
It can take a bit of time, 6 weeks at the minimum, just to sort of get some information into a document. Okay, so you're going to need to talk a bunch of things that people are going to want to see. Ownership structure. How is this thing being put together? Is it in a unit trust? Are you putting it into a discretionary trust? Are you doing some other sort of like ownership structure? How are you putting this thing together? Are you involved? Are you selling units? What's the ownership structure? Security. Security is an important thing. A lot of investors are very keen about how secure is their money. How am I going to get it back? If I had to sell it, is there something there I can sell? So have a look at either property title or company title. Where is it sitting? Are you giving people title over the company that owns the property, or are you giving the unit trust that owns the property? Are you going to give them actual title in the property themselves? That might be a joint venture where you and Joe Bloggs are on the title together, or it might be a unit trust that you and Joe Bloggs are equally invested in. Duration, how long are they going to have to sit there before they see a return, and how long is the project going to run for before they sell out? Okay, so there's two types there. There's the exit strategies and the duration. Duration is I'm going to be sitting there for 12 months while we do the renovations or while we try and find tenants for the property, so before we start getting returns. Exit strategies might be, okay, we're going to develop this property, then we're going to collect a bit of money for a 5-year time, and then we're going to sell out. But what happens if that doesn't happen, if we don't get enough tenants in, what are other exit strategies? Are we going to strata title it and sell them individually to the tenants? Are we going to be able to get out earlier if things don't meet up or meet our expectations?
So kind of just on that as well, because I saw an information memorandum the other day, and look, fair enough, it was their first development, it was their first information memorandum. But one of the things they had in there was sort of, we could do this and we could do that and we could do this. And what I like is to have that, yes, here's a clear exit strategy and here's my backup, as opposed to, we could do this or we could do that. The more uncertain you are, the more alarm bells that rings for me as an investor, as this guy or girl has no idea what they're doing. Yeah. They don't know what the exit strategy is. And that for me is, that's almost a kiss of death sort of thing. It's sort of, you don't know what you're doing or how we're going to get out of this thing. So definitely have more than one exit strategy, but have it clear, we're going to do this. If that doesn't happen, then we'll do this one, then we'll do that one. Yeah. If they don't happen, rather than, well, we could do anything. Yes. We could do this, we could do that. It just shows that you haven't thought about it enough.
Yeah, so clear exit strategy with potential, if things go wrong, then we have other ways out. Redemptions policy, how are your investors, if they want to get out, how are they going to get out? Are you going to lock them in for a period of time? Is it going to be penalties if they exit early? Be aware of all of this. You want to document that in your information memorandum so your investors are clear up front that if things go wrong, if they decide that they need to move their money out quickly to something else, or they decide they just don't like working with you anymore, how are they going to get out? What's the redemption policy? Now, all of that is before you even start talking return on investment. Now you start talking about, okay, what's the actual money coming in? How much return on investment is? I say all of that's before, but you might structure the information memorandum as a return on investment first and then go into this detail. You've got to think about the detail of the redemptions, the exit strategy, the duration, before looking at return on investment. But we might present return on investment first as the attractive first buy-in, if you like. Now, this comes back to the 3 Ps Tim was talking about before: people, project, and profit. So we want to look, a lot of people flick through these information memorandums and think, okay, who is this person? What's his experience? What's the project? What are they doing to it? Where's the exit strategies? How do I get my money back? Okay, what's the actual profit? So a lot of professionals will think through in that order, but it doesn't mean that you don't put investment first, the return on investment first. Put it up front first, and that's the thing that's going to grab people and put it in there.
Just on return on investment as well, is is when they're going to get the money. So,
Yes.
and this is what we call in our information memorandums the distribution policy. And is there going to be cash flow along the way? That return on investment, is that some cash flows? Is some of it capital growth? When are they going to get that return? So it's not just you're going to make a 20% return. It's how and how are you going to get that money, and how are they going to do the distributions to the investors? So.
Yep. Experience and likelihood. You probably wouldn't have likelihood of failure or success in your information memorandum. You may have risks in there, and you might highlight some of the market risks and other risks that are out there and how you're going to deal with those, what mitigation strategies you're going to have in place. But experience and the likelihood of success and failure, things that people are going to look at or think about when they're looking through your information memorandum. So it's good to have that in the back of your mind when you're writing it, so that you can address it through the information memorandum. Okay, experience might be clear actions that you're going to take, clear exit strategies. Okay, this person knows what they're talking about, they have experience. You might even highlight some of the previous projects you've done, even if they're not in the same space as the commercial property developments and things like that. Your likelihood of success and failure, what are the risks? At least you're starting to think about it, and people are thinking, well, you're thinking about that type of stuff. What are the risks around there? What are our mitigation strategies? Is there a risk of interest rates going up? Well, have we got enough income from the property to be able to balance that out? Things like that. And finally, a call to action. You need something in there to make people take action. Don't rely on promises to invest. Get commitments. Okay, this is I'll invest. It sounds like a great deal, Joe. I'm going to get involved. Let's look it up. I've read through your information memorandum. Give me a call when you want the money. You give them a call and they're hard to get in contact with. No, how much you're going to put down? When you're going to put it down? Let's put the money into a solicitor's trust account. Let's pay you an interest rate until we get to the settlement. Whatever. Get clear call to action. Get clear action and commitments.
Yeah, that's a good point you brought up. We went to a seminar the other day. It was all about for property funds, and one of the ideas that one of these fund managers came up with is exactly what Wayne was talking about. Is let's say you've got 3 months till settlement of your commercial property. Most people wait till right to the last minute to put the money in, because they don't want to have their money sitting there not earning anything. They'd prefer to have it in the bank, even if it's only earning 2% or a line of credit or offset or whatever. So what they do is they say, look, put the money in now, so that 3 months out, and we'll pay you a 4% return on your money. Because if they put it in the bank, they're only going to get 2%. Now you can then get that money and put it in the bank and get 2%. And yes, you're paying them 4%, but it's only costing you a very, very small period. 2% interest over 3 months. It might only cost you a couple of grand, but it means you've got the money and it's there. You're not going to get the last minute, actually I've found another deal to put the money in, or this has happened or that's happened. It's amazing what happens, from that time they said yes to actually putting the money in. Whereas the flip side of that is, as soon as someone's money is transferred, someone's actually, money's changed hands, very, very different story. Very unlikely that they're going to come and say, actually I want that money back. So
yes. Also, that also opens up as well planning. So when you're actually getting to the settlement stage, you know whether you've got enough money or not. So if you've got the money in the bank, okay, I'm getting close. I've got to do, maybe I've got 3/4 of the money there. I need to do a bit more work to get the other quarter, rather than at the 11th hour finding that you don't have enough money and you're scrambling around trying to find it.
And also great to be able to say to other investors, you're raising $1 million. Yep, we've already got $800,000 sitting in the bank. Yeah. Great, someone else has made a decision. I'm not the only or the first person making this decision either.
Yeah. Evidence for everything. Start collecting evidence. Start having that all together. You might put some of that in your information memorandum, but have evidence for everything. Start collecting that.
So if you're going to sell these titles individually, great. We want some comparable sales. You're going to get this interest rate, great. Let me show you, the interest rates that someone might charge, or a loan offer, or something like that.
Yeah.
It just adds legitimacy to every single thing that you say.
Yeah. One more thing I'll do before we go on about getting investor ready is be aware of your own personality type. Know yourself. Tim is the type of guy who acts really, really good under pressure. So you put him in a deal and he's got to get a bunch of money together. He'll negotiate, he'll put himself in the deal, and then when he realizes he hasn't got all the money together, he'll go out there and he'll call people and he'll make it happen. He's good under pressure. Some people don't like being under pressure. Some people shut down when they're under pressure. Be aware of your own personality type. If you're one of the people that shut down under pressure, then it's good to have all your ducks lined up before you put the offer in, before you commit into anything. So be aware of that, okay? The two different types of how you react under pressure, right? Steps.
Okay, so step one, get investor ready.
Yes, so we've done that.
And that takes a bit of time. Like, and as much as writing an information memorandum is a bit of a pain in the ass, and it takes a lot of time and a lot of effort, there's nothing that screams professionalism and gives someone confidence more than having that ready to go. So first thing, get investor ready.
Yep.
Next one is basically thinking of every single person you know that may or may not have some money, and writing a list.
Yep.
You'd be surprised how many people you think of when you put your mind to it. You go, oh yeah, what about Mark, or what about this, or what about my uncle, or what about this person? So then you get that big list, and then obviously you start calling.
And don't disclude people because you don't think they might have money. They may know people who have money. So, get out there and call people. Just get out there and call.
So, and then when we're calling people, it's usually we want to keep it quite high level on the phone. Hey, we got this project, and if you're personally investing in the project, I would always mention that on the phone. So, hey, look, I'm putting in $100,000. So you're not asking them to do anything that you haven't already done yourself. And just trying to gauge their feedback as to, is this something that might be of interest for you? Ultimately, what you want to get from them is, yes, I'm interested. Can you send me the information memorandum? Okay, so that's sort of the whole purpose of that call, is to sort of get them excited about the deal, and how there's a lot of money in it, and we're doing this, and it's all going well. Hey, if you're interested, I'll send you the information memorandum. What's your email address? And where you go.
Now, the last thing is follow-up. And this is important. A lot of people forget this. They think, the information memorandum is gone. He said he's interested. Great. I can leave that with him. Problem is that information memorandums are thick documents, and they tend to sit on desks, being a bit of paperweight. So you got to call them up. You got to follow them up and sort of say, hey, look, did you get a chance to have a read of that? What's your thoughts, or any concerns or questions I can answer right now? Do you want to put some money in? Do you want to get involved in this? So follow up, give them a call back maybe a week or 2 weeks later. Just keep following them up.
Because investors are lazy. I mean, look, everyone is lazy. We're all very busy. We've all got a lot on our plate, and sometimes we won't allocate a couple of hours to read this information memorandum. So be the sort of the polite pest, and you do want some sort of I suppose, time limit on it as well. Hey, we've got this deal. Hey, can you have a bit of a look at it? We're looking to finish the fundraising, in the next month or a couple of weeks or whatever it might be. But just another point on that is, when you are saying like time limit, try not to make the time limit too short a period. So there's nothing worse than, hey, I send you out an information room. Yeah, I need the money tomorrow in the bank account. It's like, it makes you look very unprofessional, but also very, very hard. And anytime you try and speed up an investor, they're more likely to say no. So just keep that in mind, and we experienced that as well when we were doing our first raise, that everything took longer than expected, and it was sort of, talking to investors, hey, we need the money, within the next 24 hours, 48 hours, that sort of thing, and very, very hard to sort of do. So just make sure you let them know, give them enough time to sort of look at it. But I like to give them, hey, if you're interested in this deal, we're going to get the money within, we need it within a month's time. And it also reiterate to them every time you speak to them, if you've had anyone else that's invested, I'd always mention that. Oh yeah, since we last spoke to you, I've had 2 other investors come on. So hey, there's only actually an allocation of $600,000 left. So they can see that it's starting to get sort of chipped away as time goes on.
Yeah, one of the things you want to do, and this is very important, you want to make it like a limited offer or a buy qualification. You want to make it like something special. Investors want to see that, feel that they've made the right decision. So you want to say, look, others got involved here. You get involved, you feel like you made the right decision. I'm going to make money out of this, and yes, I can tick that off. I'm a good financially prudent and savvy investor. I've made the right decision. Investors want to feel that they're one of a kind, they're special. people, not investors, but people want to feel that they're special. So you'll often see a lot of these seminars and events, they'll go, we're doing it by application. You might not qualify. We've got to determine whether you qualify. And that's a really great way to use the ASIC requirements as well, is to say we need to make sure that you qualify as a wholesale investor or a retail investor, whatever, as a experienced investor. It's that checklist in that, oh, I've made it, I've passed the test. So that's another thing to do, a limited offer. We're only selecting a certain amount of people to get involved with us. All those type of buzzwords and ways of putting it together to make people feel that they're special, they're involved, and that they've made the right decisions. Some tips.
So as much as you're trying to raise money, there's sometimes that you don't want to raise money from some people.
Yes.
Now, normally the big one here is basically you don't want to take, let's say someone's going to put in $25,000. You don't want to take their last $25,000, or if the $25,000 is their entire life savings, because there's a lot of emotion attached to that, which means they're more likely to be calling up, oh, where are we up to? Oh, no, oh, jeepers, are you sure this is all fine? You're more likely to get those sort of phone calls. Or if anything goes wrong or gets delayed, they're more likely to get quite upset about it. So there's those smaller investors, and sort of putting in more than they probably should. The other big one is probably more of the inexperienced investor that has no idea what they're doing, and they're almost just trusting you. They're just saying, oh, yep, you've got your information, great. Here's the money. And when something comes back, oh yeah, no, the term is 12 months. That was clearly said in the information. Oh, I didn't read that.
Yes.
Oh, I didn't know. Oh, gee, you should have told me that. It was like, well, hang on. I did tell you. It was in the documentation. So there's those type of people that you're going to get a lot of questions from. So if I look at who I take the most questions from, it's probably the people who put the least amount of money in. The guys, we've got one guy at the moment that's put over $1 million in our fund. You never hear from the guy, because he's usually too busy doing other things, and he's sort of he knows what you're doing and sort of leaves you to it. So that's a big one. The other one is probably more around personality clashes. So someone that's going to be hard to deal with, or someone that's incredibly detail orientated, that has to know every single thing about the deal and every single thing that's happening with the deal. You might spend your entire time updating them and answering questions as opposed to actually doing the transaction.
And you'll experience it. I've had it where there's I'm a relatively detailed person, but I had this investor involved in me who was extremely detailed. And so every week she's calling up for an update. Send me details, what's going on, and all the rest of it. And I bugged the hell out of me. Really did. It took a lot of my time and effort, and we're not going to be doing other things. So be aware of that. Be very careful about the investors you put involved. Sometimes, we've said family and friends here, sometimes it's an idea not to get involved with family and friends. If it's your first deal, if you feel that they're not experienced investors, that they haven't got a lot of money or a lot of spare cash lying around, getting them involved in your deal and then something going wrong can create havoc with the relationship. So just be careful of that and be aware of that. It's great to get money from family and friends. They're a very cheap and easy source to get money from, very quick. But if you feel it's going to be detrimental to the relationship, if you feel that they're not going to be able to handle any losses, or that they're not going to be financially prudent or savvy enough to deal with it, then just be very careful with it.
And I'd even have that conversation with them up front.
Yes.
Look, hey, you're investing, and people say don't mix family and friends and money and all that sort of thing. And I'd have that conversation. Look, I don't want this to affect our relationship, so I just want to make sure you're aware that, look, this does have risks, this investment, and look, you could lose all your money. And if that did happen, I don't think it will, but if it did, then I'd hope that wouldn't affect what we've got. And just having that up front, that can help. But there is some people that you just don't go there.
Yes.
And you'll know who that is.
Yeah.
Financial prudence.
Well, just before I get on to financial prudence, following on from what we just said, and this is probably another tip, I haven't got the list, but it should be, is don't put yourself in a position where you're giving away equity in a deal and then you start resenting it. I've given him 50% of the equity and I'm doing 200% of the work. I should be paid more. So be aware of what you're giving away. And remember, you're going to get in a position where you've had a very, very busy week with the property, dealing with problems and all the rest of it. And you're going to think, this he's getting 50% of the profits. He's sitting there doing nothing. And I'm the one running around doing all of it. You got to remember why you do it, why you originally did it. Come back to why you originally did it. I wouldn't have had the deal unless he came involved. He's put his money at risk. He's got most of the cash involved there. He's getting 50% of the deal. I'm still getting stuff out of it. So sometimes you're going to get that resentment. You've got to come back to the original reason why you did it. And if you're still doing it, you're still getting the things that you originally wanted out of it, then you should continue with it. Okay. Financial prudence. You're dealing with other people's money. And it's very, very important that you respect that and keep things separate, keep financial accounts, do everything that you can to show financial prudence around how you're dealing with the respect for that other person's money. This is for a lot of you, this is going to be, oh yeah, of course. But it's important and it's worth mentioning because I've had situations where a niece was going to buy, she works for Dyson, she was going to help me buy a vacuum cleaner. So I put the money in her account for a discounted vacuum cleaner that she could get. Unfortunately, she couldn't get enough of them because everybody did it. So she ran out of discounts that she could get, and I didn't end up with one. So I said, okay, that's fine, doesn't bother me, just send the money back to me. Oh, I'll have to wait until my next pay comes through before I get enough money to send back to you. Now that struck me as very, very poor money management, and that she's used the money that I've put towards this vacuum cleaner to spend on her own lifestyle, and that she can only pay me back when she next gets paid. Now, that's very poor financial management. I'd never put my money with her again. She's good. She made sure she paid me back, and it's paid back within the next week or two. But it struck me as very unprofessional. When you're dealing with money, be very, very aware that it is other people's money. It is their life savings. They are wanting security around it. They're wanting a return out of it, and all the rest of it. That you've got to be financially prudent around that. Now, I think I've banged on enough about that.
Yeah. And I suppose one way to do that as well, and especially when you're raising money, I quite like to raise the money and utilising a solicitor's trust account. So whoever your solicitor is that's doing it, say, yeah, look, we're raising the money, so yeah, if you're interested, fill in the information memorandum or whatever, and put the money in the solicitor's trust account. Okay, it's not going into Tim's pocket, it's going into the solicitor's trust account, and they hold the funds and they disperse it as the deal needs to happen. It's a psychological thing. Like when I was younger, I used to do a lot of door knocking to raise money for charities and that sort of thing. And I always used to take a big tin with me for people to put the money in. Because people thought, I put it in the tin, therefore, and they can see it's the charity tin, it's going to the charity, as opposed to them give me $20 and I put it in my pocket. Now, even though it all goes to the charity at the end of the day, it's that psychological thing of where's the money actually going and who's actually holding it. So, solicitors' trust accounts are always, just gives most investors a great degree of comfort.
Two last things on this is do what you promised. If you've written in the information memorandum you're going to pay a distribution on this date, do it. Even if it's a tiny amount, do it. Do what you promised. And if there are any problems, immediately get in contact with your investors. Come up with a solution first, or come up with what you're going to do next to develop a solution, but immediately get in contact with your investors. It is a lot better to be upfront with problems and tell your investors, this has happened, we need to sort this out, I'm going to be working on this overnight to get some solution together, rather than a week later telling investors everything's gone to pot and unfortunately the money's lost. It's a lot better being upfront. It's an easier conversation as well.
Cool. Alrighty, final thing here. You may have seen this slide before. This is the 3 levels of fundraising in Australia. Now, this is really only when you want to get into the business of raising funds. So the very, very first level is the small scale offer, this is where everyone starts, where you can raise money from the public, but it's capped at $2 million, 20 investors in a 12-month period. So every 12 months you can do, $2 million. Now, you can do this, as long as you're not in the business of setting these things up. And the other thing you can't do is, I'm going to go set up ABC company and raise $2 million, then I'm going to go set up CBD company and raise another $2 million. If you're the person behind both of those schemes, if you like, or both of those offers, then it'll get pulled together. So it's it's quite an attractive thing, and this is really for the smaller players in the marketplace to get rid of a lot of red tape and licensing. You don't need an AFSL, and you just can't do any advertising for it. It's mainly more about personal offers and dealing with family and friends that you can raise money.
AFSL, Australian Financial Services License.
Yes. And as we said before, under this the $2 million, if you got money from a wholesale investor, so if you got money from say Wayne, and he put $500,000 in, then that wouldn't count towards that $2 million cap. So it's only the retail investors that is that cap. Okay.
You can't advertise.
No.
It's only through personal contacts and the people you know. So be aware of that. That's why we say call them up, have a chat with them. If they ask you for an information memorandum, send it across. Don't send it out blank. Send a blank information memorandum out to everybody. Don't stick it up on open Facebook group and stuff like that.
Yeah. So, however, we did with what we did as well. We did post something on Facebook, but it was only to our friends.
Yes.
So that was
we asked them not to share it.
Key distinction there. Yes. Okay. The next level up, and this is more when you are getting in the business of fundraising. And this is where we're at with PMA and with Active Commercial, is to raise money for our funds, is that we've had to go in and basically get authorised under an AFSL, and we've done it with a wholesale authority. So when you get into this level, when you've got an AFSL, there's no caps on how much you can raise, but you do need to have that AFSL, which means there's a lot more that you'll need to put into the information memorandum, and whoever the AFSL license holder is, they're going to have a lot of requirements because they're basically putting their ticket on the line. But if anything goes wrong, they're going to go to the AFSL person and say, hey, why did this investor lose money, or what happened here, to protect those investors. Now, this is if you're raising money from wholesale, or what they call exempt investors, so basically non-retail investors. So this is like we spoke about before, someone that's earning 250 grand a year, 2.5 million net assets, or more than $500,000. So that's where most people kind of I suppose sort of stop. The third level is really only if you want to go really big, and this is where you're setting up a massive fund, you're raising tens of millions of dollars. Is where you will get an AFSL with a retail authority. So when you've got a retail authority, a lot more requirements. Your scheme or your fund will have to be registered with ASIC. ASIC will go through your information memorandum, or it'll actually be a PDS, with a fine-tooth comb to make sure every single thing is ticked off and everything is done correctly. Because ultimately it allows you then to advertise. So you can go up to anyone in the marketplace and say, hey, I'm raising money for this project. And the idea is that the information memorandum, the PDS has all the information that a general member of the public or a retail investor would need to know to make an informed decision to invest in the fund. Mm-hmm. So I don't think that's really for you guys or anyone really at the moment. It's definitely the higher end of town. But we just want to let you know, I suppose, the certain levels. But there's a lot of flexibility at level 1, and it's some people that's all they need.
Yeah. Guys, you're probably going to have questions out of this. Now, we want you to spend the next couple of weeks thinking about questions. Email them into us. We're going to host another webinar where we're going to get your questions answered. So this gives you the opportunity to think of any questions you like, send them in. And we'll get Andrew back on the line and get any questions you have answered in the next webinar. Cool. Thanks for being with us. It's been great. Cheers.
Thanks, guys. See ya.
Bye.